Okay, good morning. What we're going to do today is we are first going to finish up Chapter 3. I've got some, when I get through the rest of the chapter, and then I think I've cut it down enough so we'll have plenty of time at the end. I'm going to go over the high points of the exam again, and then we're going to have question and answers. And I'm going to take questions from people in class and online, and I'll address any and all questions during that time. So we're going to get started first, and so any exam questions we will get to the latter part of class. So first thing, we have a question, what's due this Saturday? So this Saturday, I guess I put this in a different order, Chapter 3 homework. That's what you have to do this week. The Chapter 3 homework will take you a fair amount of time. Yesterday, I emailed out a list of links for every single exercise. So we are going to do some of them today. We did some Monday, and then there's a whole bunch of other ones, not a whole bunch, but a fair number. So Chapter 3 homework is due this week. Now, the Practice Exam 1 quiz is due before you take the exam. And the last possible time that you could take the exam, you have to start it before 4 p.m. on February 17th. So the Practice Exam quiz is not due this weekend. You can certainly work on it, but it's not due this Saturday. Okay, that question that's out there, Learning Catalytics, will close sometime in the next few minutes. So if you're just joining us, you could still answer the question. But there is an exam next week, Monday through Wednesday. You have to start before 4 on Wednesday. And again, I'm going to have a significant portion of time at the end of class for questions and answers. I'll take questions from people online and in class here. Okay, so we're going to start with the material. So we're going to start with a quick little review of something we did Monday. And this is something you should write down. And this is a huge hit because you're going to have a couple questions on it coming up. So there's 3 kinds of adjusting entries. First of all, we have deferrals. Deferrals are when we get cash before the revenue or expense. This slide here, by the way, is not technically in the PowerPoints that I have on Blackboard. It was something as I went through yesterday, something that I found would be useful. Kind of a summary. So there's 3 types of adjusting entries. The first are deferrals. That's when we get cash before the revenue or before we pay the cash before the expense. Example of this would be when someone pays us for a job before we do it. That's unearned revenue. Or when we pay for something before we use it up. That would be like prepaid insurance. We pay a year in advance. If we pay our rent in advance, that's a deferral. So deferral, the cash changes hands before the revenue is earned or before the expense is incurred. Okay, so that's one type of adjusting entry. The next type of adjusting entry is depreciation, which we're going to talk about today. There's a whole chapter devoted in the book to depreciation as well. And then the third kind is accruals. And accruals, the revenue is earned or the expense is incurred before cash changes hands. So we have 3 types of adjusting entries. Deferrals, where cash changes hands before the revenue is earned or before the expense is incurred. Depreciation, which has to do with long assets that are going to be around a long time that we use in our business. And then accruals, and this, the revenue is earned or the expense is incurred before the cash is paid. An example of a revenue accrual is when you go into the doctor's office and they do their thing, and then you walk out the door and they bill your insurance company. They have performed the service and they're waiting to get paid. An example of an expense is you use electricity all month. At the end of the month, you have used that electricity, but you aren't going to pay it for a month or so till the bill's due. So that's an accrued utility expense. So we've got deferrals, depreciation, and accrual. And those are the 3 types of adjusting entries. Guaranteed you're going to see a question on this probably in a few minutes. Okay, so, and that was kind of where we left off. Yeah, on Monday, we went through adjusting journal entries for deferrals. So today what we're going to do is we're going to do depreciation briefly. We're going to do accruals, and then we're going to finish out something called the accounting cycle. Okay, so depreciation of plant assets. Again, the PowerPoints that are online have a lot more words than what I have here. Plant assets are things that have long lives that we use in our business. Examples are land, building, furniture, equipment. Okay. So the depreciation is the process of taking that cost of that asset and spreading it over the life of the asset, making the cost, putting the cost into expense. Let me just talk about this conceptually. So let's say we spend $1 million, we buy a building, and we're going to be in this building for 20 years. We're going to use this building for 20 years. So when we spend $1 million on the building, it's not like we take that $1 million and subtract it as an expense on the income statement. That building, since we're going to use it over 20 years, we say, well, gee, we're going to take that $1 million and divide it by the 20 years and take 1/20th of it as expense every year. So we're allocating the cost of the building over the life of when we're going to use that asset. Now, there's one exception. We never depreciate land. Land is considered to be an indefinite asset. It doesn't wear out. It'll still be there. If we own a piece of land, it's not going to crumble over time like a building. So whenever we talk about depreciation, we're talking about all the long-term assets, those plant assets, furniture, fixtures, and equipment, except for land. Land does not ever get depreciated. And again, we're going to see this in a chapter. We have a whole chapter on depreciation coming up. So we'll see some of the differences. But in this chapter, what we're going to do is I'm going to show you one adjusting entry. We're going to do it and then move on to the next type. So this is depreciation, the second type of deferral. Remember, adjusting entries, we have deferrals, depreciation, and accruals. So we did deferrals Monday, depreciation right now. So let's say that we purchased equipment on account for $24,000. Okay, so this is not the depreciation entry. This is what we do initially when we purchase equipment on account. So equipment is an asset, so we're going to debit it to increase it. And then on accounts are those magic words that say this has to be accounts receivable or accounts payable, and it has to do, accounts receivable is with our customers, accounts payable is with our vendors or suppliers. In this case, this is the supplier we purchased it from, so it's going to be accounts payable for the $24,000. So just our equipment account will have a debit balance of $24,000. Accounts payable, as we post it, has a balance of $24,000. Equipment is an asset. Okay, so we've got asset going up, we've got a liability going up. So that's not the depreciation entry. That's what we do when we purchase it. Now, we buy this equipment. This equipment is not going to last forever. So we don't want to just say the $24,000. We don't want to just leave it in equipment. Well, we don't want to leave it as an asset forever. But we also don't want to take the $24,000 this year and stick it in expense, because we're not using it all up this year. It's going to last several years. So that's where we get into the depreciation. We're given another fact, that this equipment will be useful to the company for 5 years, and then they're estimating it'll be worthless. It doesn't have a trade-in value or anything like that. So that's a fact we're given. So now what we're going to do is we're going to figure out the depreciation. The depreciation, what we do is we divide it out and we spread it over the years or the months. In this case, we're going to do it by, let me go back. Oh, I skipped a step here. Okay, so back here, there's one calculation that's not showing on the screen. $24,000, we said it would be good for 5 years, right? So the calculation that's missing on this next screen is 24,000 divided by 5 years. Okay, so yearly depreciation, 24,000 divided by 5 years is 4,800. Would you make a note of that? I'll change it. Oh, maybe I'll just do it right now. Okay, so somewhere, so we'll take 24,000 divided by 5 years will give us 4,800 per year. That'll work. Okay, so this equipment is good for 5 years. We'll take the 24,000 cost, divide by 5 years, get $4,800 depreciation per year, and then in this case, we are doing depreciation by month, so I'm going to take the 48,000 divided by 12 months and get $400 a month. Now, when we do our depreciation chapter, our chapter that's on plant assets, on these big things that we buy that last several years, we'll see several different ways to do that depreciation calculation. This one that we're using right here is called straight line. It's the easiest. It's probably the most common use, where we just divide and get the same amount every month and be done with it. So that's what we've done here. We're just saying, okay, we're spreading the cost of the $24,000 that we purchased for this equipment. We're spreading it over 5 years. And how much is that per month? That's all we're doing here. Okay, so now we're going to do the adjusting entry. Now, we just calculated the depreciation back here. Depreciation is $400 a month. So our journal entry here, you know it's going to be a $400 debit and $400 credit. So you're half done. You just need account names. So the first one, depreciation expense, $400. We do sometimes you'll do depreciation on equipment, sometimes depreciation on building, whatever it is. Depreciation expense, and then our credit is to this new account called accumulated depreciation. And so notice that the second line is indented since it's a credit. And we're going to get, next slide I'm going to talk about what accumulated depreciation is. So what's happening here is depreciation expense is debited, increased for $400, and then we have accumulated depreciation on equipment for $400. This entry, adjusting entry for depreciation, will always look the same. We will always debit depreciation expense, and we will always credit accumulated depreciation. Which leads me into my next point. What's accumulated depreciation? Accumulated depreciation is called a contra asset. Okay, you should know what a contra asset. A contra asset is an asset. It belongs with the assets, but it is opposite contra. So it has a normal credit balance. It offsets the asset that it matches. So accumulated depreciation is always shown, if this is accumulated depreciation on equipment, it is always shown with equipment. And this is the accumulation of all the depreciation that we've taken to date. So whenever we do any depreciation, it goes into accumulated depreciation. Okay. So accumulated depreciation is a contra asset, meaning it behaves backwards from every other asset. It is always paired with the matching asset. So it'll be equipment, accumulated depreciation. So what we have then is something called book value. Book value is a very, very common term, sometimes referred to as carrying value. It's the original cost of the asset minus the accumulated depreciation. You have to know what that is. If I say to you what's book value, you need to know original cost of the equipment minus the accumulated depreciation. In our example here, the equipment's original cost was $24,000. Accumulated depreciation, we've only had 1 year of it, was $400. So the book value of that equipment is $23,600. And that's about as far as we're going to get into depreciation. Depreciation, so we had some language we need to know. We need to know that accumulated depreciation is a contra asset. When we do depreciation, it all goes into accumulated depreciation. Then we could take the original cost of the asset minus the accumulated depreciation, and you get its book value or carrying value. Okay, so we have a question. I've got several answers already. Good. Which of the following is not one of the three basic categories of accounting adjustments? Remember, it says that slide, write this down. Okay? So which of the following is not one of the three basic categories of accounting adjustments? Expenses, deferrals, depreciation, or accruals. Which one of those is not a type of adjusting entry? I'm going to close it in about 5 seconds. And then that write this down slide, you're going to need it coming up in a few questions from now as well. So don't discard it yet. Do you guys have a question over there? Thanks. Okay, so the answer is expenses. Remember, it's deferrals. Deferrals are where cash changes hands before the revenue is earned or the expenses incurred. The next category is depreciation, and the third category are accruals. Accruals, the revenue is earned or the expenses incurred before cash changes hands. So expenses are not an adjusting entry. Okay, so now we get into the accruals and the types of accrual entries. Accrued expenses. So accruals, we can have accrued expenses, we can have accrued revenues. So accrued expenses, we record the expense before the cash changes hands. For example, we can have salaries. Our employees work, the pay period finishes, and we may not pay them for a couple weeks. There might be a couple week lag in the paychecks. So that would be an accrued wages entry we would need to do. Interest, we have loans. The loans, we incur interest on them, and then we need to accrue the interest because we may not pay it the day it is accrued through. Usually there's a time lag there. Taxes. The end of the year comes, and we know this on a personal basis. The end of the year comes, December 31st comes, the year is done, we have earned our income, and then we may have to send a check in with our return when we do it on April 15th. Well, those are accrued taxes. If we are a business, we would need to make an entry for the year to accrue our taxes that are due, but we're not going to pay yet. Rent. Sometimes we pay rent after the fact. That might be an accrual entry we need to make. So depending on our agreement with our landlord, rent can be a prepaid expense or it can be an accrual. It just depends if we pay it ahead or pay it afterwards. Okay. We also have accrued revenues. Accrued revenues, the expenses recorded before the cash receipt. Examples of this would be services performed, which would be the doctor's office. If the doctor's office bills the insurance company after the services are performed, that would be an accrued revenue. Rent, if we're the landlord and we and they pay rent after the month is over, and then interest, if we have a loan we've made to someone and they pay us interest afterwards, that is accrued revenue. Okay, now accrued revenue is we've performed the service, but we haven't gotten paid yet. Now that's an accrual. I want to contrast that, go back for a moment. This is the deferral. Deferral, unearned revenue. Right now in your notes, unearned revenue is a liability. Unearned revenue is a liability. It means that someone has paid us up front for revenue we have not yet earned. For example, airline tickets. When you pay for a flight, the airline does not recognize revenue until that flight actually takes place. Magazine subscriptions, if you pay for something, a year's subscription, the magazine does not recognize revenue until each month goes by. If you pay rent in advance, they do not recognize revenue until the month has gone by. If a customer makes a deposit towards a job that is not done yet, it is not going to be revenue until the service has been performed. Concert tickets. If you buy a concert ticket, the musician does not recognize revenue until that concert is performed. Okay? So unearned revenues. In your notes, you have unearned revenue is a liability, right? Something else to put in your notes somewhere, because I know it's coming up. Prepaid rent. Prepaid rent, prepaid insurance, any of the prepaid accounts, those are assets. Just a reminder, these are things you need to know. Unearned revenue is such a misnomer because you look at it and you say, unearned revenue, that should be a revenue account. Unearned revenue is a liability because that says you still have to perform services or deliver goods for this amount. So unearned revenue is a liability, prepaid rent, prepaid insurance, those are all assets. Anything prepaid blank is an asset. Okay, in your book, I'm not going to replicate it here, but in your book, Exhibit 3-6 is a summary of all the adjusting entries. And if it's also in the PowerPoint slides that you can download, that exhibit is replicated as well. So I just wanted to point that out, that is a summary that if you want it all in one place to look at, that's a nice place. Okay, and then we have one more term coming up, and we're going to do a few questions. The next term is this thing called an adjusted trial balance. An adjusted trial balance shows all the account file balances after adjusting entries. And we use it to prepare our financial statements. Okay, up to this point, so what happens in the whole scheme of things is we conduct business. Transactions happen. So then we look at those transactions, we write journal entries for them, we post them to the accounts. And after we post them to the accounts at the end of the month, we do a trial balance, which is different than an adjusted trial balance. A trial balance is basically saying, do our debits equal our credits after we posted all our transactions. So then that happens, and then after we do this trial balance, which is our initial pass-through, then we do all these adjusting entries that we just talked about. The purpose of adjusting entries is to make sure our revenue and expenses reflect what actually happened. So after we post all the adjusting entries, we then do a new trial balance, but this new trial balance is called an adjusted trial balance. So that term adjusted is important because it tells you this is after we did all the adjustments. So this is that final list of balances. So the adjusted trial balance is not a financial statement. It is a listing of all the account final balances, and then we use the adjusted trial balance to prepare financial statements. And this is, when you look at all that's happening, you see transactions occurring, we post the transactions, we do a trial balance, we do adjusting entries, we do a final trial balance, we prepare financial statements. This is all part of something called the accounting cycle. It happens every accounting period. You analyze your transactions, you post them, or you write your transactions, journal entries, you post them, you do a trial balance, you do adjusting entries, you do an adjusted trial balance, you do your financial statements, and then coming up here in a minute, we're going to look at our final step of the accounting cycle, which is close our accounts. So we'll get to that. But before we do, we're going to do a couple questions. These should be pretty straightforward. Okay? First question, what type of account is prepaid rent? First 58 people got it right. Okay, on this one, let's talk about prepaid. Now again, I'm not meaning to scold, but these are things you need to know for the exam. This is part of, like, if you're a doctor, you need to know basic anatomy. This is basic anatomy in accounting language. So you need to be able to recognize what kind of accounts there are. Remember when I said, oh, here's the sheet of some examples? You should bring that with you to class. You should know the sample assets, liabilities, equity. And I just said this one. Prepaid rent is rent we're paying in advance. So it's rent we're paying before the expense actually happens, okay? So what that is it is something that has future economic benefit to us. And by definition, prepaid rent means we've already paid it, and it, okay. Prepaid rent is not a liability because we're paying it ahead of time. There is no liability here, so it can't be a liability. Prepaid rent is rent we're paying for ourselves. It cannot be a revenue account. Okay? Prepaid rent has not yet been used up. Prepaid means that we're paying it ahead of time. It has not been used up, so it can't be an expense yet either. So by default, we're left with one answer. I'm going to close this in 5 seconds. Okay, it is an asset. Okay, prepaid rent is an asset. Prepaid anything is an asset. Okay, another one. Let's do another one. What type of account is unearned revenue? Unearned revenue is when we collect cash for services that we have not yet performed. So it's like we collect for a flight that hasn't been, we're an airline and we collect for airline tickets for flights that we haven't flown yet. This could be a concert, a musician who collects for tickets for an upcoming concert, but the concert has not been performed yet. These are gift cards. So we've sold gift cards and the people have not yet used them. That's unearned revenue. So what kind of account is that? Going to close in about 5 seconds. So unearned revenue means that we have an obligation still to do something. We have an obligation to perform the service or to deliver the goods. We have not yet done that. So unearned revenue. Unearned revenue cannot be an asset. It cannot be an expense. It can't be revenue because it's unearned. So by default, remember, this is that one account that is not, it's not what it sounds like it is. Okay, so it is a liability. Okay, then one more A deferral is an adjustment for payment of an item or receipt of cash in advance. And in parentheses, I put in, there's parentheses on the one on the screen, not on the one in on your device. This is cash before the revenue or expense. Is that a deferral? It's a deferral when you have cash before the revenue or the expense. Again, remember that first slide we started out with? Let's write this down. Okay, so hopefully you got that one. It's going to close in 5 seconds. But yes, a deferral is when you collected cash before you've actually earned the income, or you've paid cash before you actually have used up the expense. That is, by definition, a deferral. Okay, so now we're going to do a couple homework problems. And these are examples of accrual adjusting entries. So this first one, 2 really short ones. First of all, we have exercise 3.7, Paradise Travel prepaid $6,000 for 6 months rent. Give the adjusting entry to record rent expense. So October 1st, they paid $6,000 for 6 months of rent. Okay, so what I'm thinking in my head right away is $6,000, 6 months means my rent's $1,000 a month. So give the adjusting entry to record rent expense at the end of October. So we paid for it October 1st. It's now October 31st. 1 month has gone by. So what we're going to do in this first one is we are going to debit rent expense and credit prepaid rent. Because when we paid the rent, it didn't ask for the original transaction here. It asked for what we're going to do for an adjusting entry. So what we're going to do is when 1 month's rent goes by, we're going to recognize rent expense, 1/6 of the $6,000, because 1 month has gone by. So we're going to debit rent expense, and we're going to credit the original asset, prepaid rent, for $1,000 to record rent expense. Okay, next entry as we go then. So this is just simply saying we're going to recognize 1 month of rent every month that goes by. So that was October. We recognized 1 month. Now, it says that we need to show the account balances at the end of October. So at the end of October, prepaid rent, we would have our beginning balance, which is $6,000. That's when we originally paid for the rent. Okay, so we originally paid, this is an asset, so it would have been debited to prepaid rent, and then this prepaid rent credit here is credited over here, and then our balance is the difference between the two. So we have the $6,000 minus the $1,000, and we get a balance of $5,000 in prepaid rent. Rent expense, on the other hand, is just $1,000. So that underline in the T account just says we're dropping in the balance here. So when T accounts, again, you add up the ones on the numbers on the left, you add the numbers on the right, take the difference between the two, and put it on the side that's larger. Okay, next one down. Next one down, on October 1st, Paradise Travel paid $950 for supplies. So the company paid $950 for supplies. They're not using those today. They're going to use them over the next few months. So when they paid for the supplies, they would have debited supplies and credited cash or however they paid for it. Cash. That's what they did. Now we're being told they paid $950 for supplies. At October 31st, they have $270 of supplies on hand. So on October 1st, they had $950 of supplies. They did a count at the end of the month, and they have $270. So the difference between what they started with and what they ended with has to be what they used. So what we're going to see there is the adjusting entry here is in a debit supplies expense, and it's for the difference. We started with $950. We only have $270 left. What happened to it? We used it. So we're in a debit supplies expense, credit supplies. Supplies is an asset. Okay, and then it asks us for the account balances. So we are going to, we know that the original balance for supplies, that original, when we first purchased it, we had supplies we purchased for $950, it's an asset. Then we have the supplies being credited for $680. The difference between those two is $270, which is what our inventory showed. It showed that we had $270 on account, and then $270 left. And then the supplies expense is just the $680 that we had in the journal entry, the adjusting journal entry. Okay, so we did a sample of adjusting entries. Adjusting entries are much the same over and over. We're going to now do the next step. So let's assume we've done all our adjusting entries, we've posted them, we do an adjusted trial balance, and we use that adjusted trial balance to do our financial statements. So I'm going to illustrate this with part of exercise 315. Exercise 315, they're giving us a series, they're giving us a bunch of account balances. These are in no particular order, and we're not told if the account balances are debit balances or credit balances, but we know that from their normal balance. Remember, their normal balance is whatever increases in account. So it tells us, use these data to prepare the income statement, the statement of retained earnings, and the balance sheet. What I'm going to do here is I'm going to do one of the statements, not all three. I'm just going to do one. This is one of the ones that I put out the little video on how to do. So the whole thing, if you need more help with it. If I were doing this one, by the way, as I'd work through it, the first time when I did it, use that Help Me Solve This. It's going to walk you through it too. But we're going to go through the first, we're going to do the single step income statement because we've already seen a statement of retained earnings and a balance sheet. So income statement, every statement starts with, first of all, the name of the company. The second line is the name of the statement. The third line is the date line. An income statement, a statement of retained earnings, and a cash flow statement always used for period ending. The balance sheet is the only one that just has a single date. Okay. So we have the income statement for the year ended, and what we're going to do now is we're going to go up above and pick out all the revenues. A single step income statement, we're going to have revenues up here given to us. Okay, we have revenues of 180. Okay, so that's where we're getting the net revenues below. Next, it will ask us for cost of goods sold. Cost of goods sold is given up here as being 136. And then there's one other expense. All other expenses are on the other side here. So we have a total of 3 expenses. Cost of goods sold is always the first expense. If you have cost of goods sold, it's always first. So we have revenues, we have cost of goods sold, all the other expenses, and we end up with net income. Again, when you're putting any answers in homework, I did have someone the other day, when they put their answer in, put a $ space 14,900. You can't, my accounting lab is really forgiving of anything except spaces. So when you put in your answers, you don't need to use $signs. It absolutely makes no difference. It's just something extra to type. I wouldn't do it because there's too much chance that you want to put a $sign or a space in there. So my accounting lab, just in this case, I would put 14900. Okay, so just a tip there. There's no need to put $signs in my accounting lab, because then you start putting spaces in. Or sometimes I'll see sometimes someone will hit the space bar before, and then it's so frustrating because your answer looks right, but it doesn't like spaces in numbers, which none of us like spaces in numbers. Okay, so this is the income statement. Single-step income statement just means that we're not doing a subtotal for gross profits. Okay, now the next statement here, I guess I'll do one more. The next statement is statement of retained earnings. Statement of retained earnings, again, name of the company, name of the statement, and the date line. That's going to be the same as every statement. The only statement that just has a single date is the balance sheet. Okay. So statement of retained earnings, you're going to start with your beginning retained earnings, which is last year's retained earnings. Okay. So last year's retained earnings right here, and we know it's last year because it's telling us July 31st, 2013. So that is 1 year before here. So that's our beginning retained earnings. Then we're going to add net income, get retained earnings, ending retained earnings. Okay, now the rest of this exercise is a balance sheet, and I'm going to let you do that on your own, and it's on the recording that I sent out yesterday. So what we're going to do now is the very last thing in the chapter. So the last thing in the chapter is the last part of the accounting cycle, which is the closing the books. So now, what we've done so far is we've had transactions occur. We've written journal entries for the transactions. We've posted the transactions, the journal entries, to the accounts. We've made a trial balance to make sure our debits equal our credits. Then we've done adjusting journal entries, and then we do an adjusted trial balance. We do the financial statements. We're at the end of the year. The financial statements are prepared. We need to close the books to prepare us for the next year. When we close the books, let's see, we prepare the accounts for for the next period. What we're doing is we're setting the revenues, expenses, and dividends to 0. Okay? Revenues, expenses, and dividends. An acronym to remember those is RED. Revenues, expenses, dividends. Those are called temporary accounts. If we are at the end of the year, we're getting ready to start the next year, there's some accounts that we have to close out to make them 0. They're called temporary accounts. Let's start with the permanent accounts. The permanent accounts are our assets, our liabilities, stockholders' equity. Those permanent accounts carry their balance forward year to year. Let's think of cash. Cash is the easiest one to think of. Cash. So cash, year to year to year, when the end of the year comes, let's say your company has $10,000 in the bank at the end of the year. When January 1 comes, this was the end of the year 2015. So December 31st, 2015, I have $10,000 in my cash account. Then January 1, we opened for business, and we still have $10,000 in our checking account. It didn't go away. That's called a permanent account. Okay, so we do not close permanent accounts. Permanent accounts are going to be the balance sheet accounts. Okay, so everything on the balance sheet, nothing gets closed. Okay, assets, liabilities, equity. Equity being retained earnings and common stock. Okay, but let's think about a different account. Let's talk about sales revenue. So we go through the year, we're adding up sales revenue, getting more and more sales revenue. We know what our sales are for the year. And so at the end of the year, let's say our sales for the year were $300,000 for 2015. So now, January 1 comes 2016. What are our sales for 2016? Zero, right? We haven't sold anything. So we have to close out that balance. It's like closing it out, starting a fresh year. So what we're doing with closing entries is we're taking everything in revenues and expenses, which if you take the difference between revenues and expenses, it's net income. We're taking that and we're closing it to retained earnings. We're wiping out the temporary accounts. The thing that you need to memorize here are what are the temporary accounts. The acronym RED will get you there. Revenues, expenses, and dividends. Those accounts are closed. And what we want to do when we close them is zero them out. So whatever increases them, we're going to decrease them. We're going to close everything to retained earnings. Retained earnings, going back to the beginning, retained earnings goes up with income and goes down with dividends declared. That's what we're doing. Retained earnings will actually increase for revenue, decrease for expenses, and decrease for dividends. We're closing all those temporary accounts so we can start the year fresh at zero, because when we talk about sales for a year, we're not talking about last year's sales. We're talking about sales just for this year. When we're talking about salaries expense, it's for this year. It doesn't just keep building up like cash would. So what we're going to do here is we're going to do an example. And this one's in the PowerPoints, but we have a list of balances given to us at the end of the year. So we're given this list in random order, and the first thing we're going to do is back here to this acronym RED, revenues, expenses, and dividends. We have to close all of those. So I'm going to do them in that order. I'm going to close my revenues, I'm going to close my expenses, I'm going to close my dividends. Closing entries, once you get that, they're the easiest entries to do, because what we're doing here is we're closing revenue accounts. Okay? And what are my revenue accounts? So I'm going to go through here and I see revenue. Now, here's where we need to know our debit credit rules. And again, you'll have your exam info sheet that has, which accounts have the debit credit rules. So revenue, the rule with revenue is revenue increases with a credit. Okay? So to close it, to make it zero, we need to debit it. So you do, for closing entries, you're going to close revenues, expenses, and dividends, and you're going to do the opposite of what increases them. So I'm going to debit service revenue. So I'm just taking the balance there. I'm also going to look, there's another revenue account there. There's interest revenue. So I'm going to debit that. And then there are no more revenues up there. So I'm going to add those two numbers together, and revenues, expenses, and dividends, all of them get closed to retained earnings. So every single closing entry you have, retained earnings will be in it. So you're going to close your revenue. So you're going to close revenue, any revenue accounts you have, add them up. Your credit is going to be to retained earnings. And I got the credit to retained earnings by adding my two revenues together. So closing entries are the easiest thing you can do because they're the opposite of what increases that type of account, and the other side is always going to be retained earnings. Okay, so that's the closed revenue. That's a closing revenue entry. You would debit all your revenue and credit retained earnings. Okay, your next up, you'll close your expense accounts, and what you're going to do there is you're going to find all your expense accounts. Now, expenses increase with a debit, so I'm going to skip a line and I'm going to credit each expense. So I'm going to credit cost of services sold, I'm going to credit general selling and administrative expenses, and I'm going to credit depreciation expense. And income tax expense is also on there. So I'm going through finding all my expenses, I'm crediting them. So notice that I skipped a line, I did all my credits. Why did I credit expense? Because expenses are increased with the debit. I'm doing the opposite. I want to wipe them out. I want to make them zero. So then my debit is retained earnings, and I got that debit by adding all my expenses together. So I add those 4 credits I had, I get the debit for expense. So we have 3 closing entries. We close our revenues, we close our expenses, which we just did here, and we have 1 more closing entry. There are 3 types of temporary accounts: revenues, expenses, and dividends. So now we close dividends. Dividends are given to us. Dividends, when you see the account dividends, that's dividends we have paid. The corporation has paid. If it would be dividends they received, you would always see dividend income or dividend revenue. It will specifically, or it'll say investment income. If you see just the word dividends, it's dividends the company has paid. So what we're going to do, dividends increase with a debit, so we're going to credit dividends. We're going to debit retained earnings for that. So the dividends entry, there's 1. Okay, now we've got our 3 closing entries. So what we would do is the first question, how much income did they earn during the year? It's going to be our revenues minus our expenses, which were actually wow, that's a little off. Huh, okay. Well, that's the best I can do right now. Okay, revenues, that's from our revenue closing entry too. Our expenses are from our expense closing entry. Our net income is $13,800. Notice that dividends are do not reduce net income. Dividends never impact net income. And then the last thing we can do with this is we can show the T account of what happened. So the beginning retained earnings balance, retained earnings has a normal credit balance. So the beginning balance is right here, the $5,200. We would, here's our credit for our revenue closing entry. Here's our debit for our expense closing entry and our debit for our dividends closing entry. So we add our debits up, we add our credits up. The difference between the two is $18,400, and that would be a credit balance because the credits are larger. Okay, so that's kind of in a nutshell our closing entry. So now I'm going to segue really fast into, because I want to allow enough time. So we've got about 15, 20 minutes left here. I'm going to come back to this material in a minute, but now I just want to kind of head over to do exam question and answers, and I'm going to come back to some of this if we have time. So do you have any questions for me? Saved up? Okay, yeah. So you don't have any questions for me right now? Okay, so does anyone in the room, as I segue in, I'm going to go over to talk about exam. And let me. Okay, so our exam is February 15th through February 17th. The exam chapters are chapters 1, 2, and 3. What I find on the exam, the average, the first exam, the average will be around 70%, 69, 70%, somewhere in that range. There is and so none of this is new. I said this on Monday, but I want to reiterate it. There is a practice exam. It counts as a quiz, and that practice exam, every time you take it, will be different. And your You need to work through it. You cannot just look at it and think, oh, I'll get that, just guess and get a really bad score. Someone asked me this last week about why I don't do the highest of your quizzes and do the average instead. And what I found happened over time when I said, oh, you'll just get your highest score, is what people would do is they'd go into the practice exam, open it up, enter a couple answers, submit it, and then do it again, and end up with 4 attempts that they spend a total of 10 minutes on, and then do it for real for the 5th one, not do so hot, and then do really bad on the exam because how they prepared for it was they just looked at the answers. Now, accounting, I can make anything look easy, but when you try to do it, it's a little bit different. Accounting requires practice. You're going to have to practice it, and I want you to practice it. If the idea of doing a practice exam for a grade, the average grade, really upsets you, know that you can go into Study Plan. Study Plan has all the information in it. You can practice this content in Study Plan. In Study Plan, there's a quiz me option. When you first go into it, there's a quiz me option, and that's going to bring up random questions. There's a way, and I put it on Blackboard, there's a way, I have a little video on how to use Study Plan. It'll show you how to get into all the content. So if you want to practice it and you don't want the grade and that just freaks you out, like I don't want to practice and get a bad grade, do Study Plan. Practice in Study Plan all you want. That's open. Study Plan will not impact your grade in terms of your grade calculation. There are no points for Study Plan. But what will impact your grade is the practice quiz. Now, if I were studying for this exam, I would work my way through the practice quiz, make a good attempt at it, go through it, use the Help Me Solve This, use all the aids that are through, and then after you do it one time, you'll see your score, and that'll kind of give you an idea of what that exam is going to be like. But what you need to do is if you get a poor score, you need to head over to Study Plan and practice, practice, practice. I would absolutely, if it were me, I would take the practice quiz all 5 times because you're going to see different content on each attempt. The practice quiz, the practice exam, I'll tell you right now, it's just like the exam. That's the same format. It's pulling out the same pool of questions. So yes, and when you go to take the exam, do not expect it to be easier. Your grade on the, typically in the typical average student, whoever that is, what I will see is the exam score will typically be a little bit lower than the practice exam. That's a typical student who is prepared because you don't have to help me solve this, you don't have your notes, so of course it's going to be a little bit lower. Now what is alarming to me is when I see someone spend like 3 hours on the practice quiz and get a really good grade and then go take the exam and not do so well. Well, because when you spend 3 hours, you don't have 3 hours for the exam. The average, again, the average person spends 45 minutes, but if you're spending a long time on the practice exam looking things up, no, you're not going to be able to do that. But if you could take the practice exam a few times in a row and things are familiar and feel comfortable, you're probably going to be okay. So, see, can I answer these? Okay. Can you please review how to properly enter our answers in the exam? You will answer them exactly like you used in My Accounting Lab. It's the same platform. The exam is in My Accounting Lab. So dollar signs and commas, you can enter those all you want. That's fine. You don't have to. Dollar signs and commas are not required if you want to. The reason I stay away from dollar signs is there's too much of a tendency to want to put a space in there. So it's going to be exactly like you do. And I'm just reading the past questions that you answered. Is there the same amount of questions on a practice exam as the exam? Yes, they are the same. It'll be virtually the same. When I say the same, I mean within 1 or 2 questions, but it will be the very, very similar. Structured the same way. There is not a curve on the exam. There is no time limit on the practice exam. There is a 2-hour time limit on the exam. Very seldom does anyone need 2 hours. There's plenty of time. Is our exam on My Accounting Lab? Yes. Yes, the exam is in My Accounting Lab. And I emailed everyone. So everyone should have gotten an email from me yesterday that said, here is where you're taking your exam. And that email went to you specifically because that is your exam location. If you show up in the wrong place, if you're in section 5 or 6, if you're in section 5 or 6 and you show up in the computer lab, your exam will not open. Okay, it just simply won't work. If you're in sections 1 and 2 and you try to take it with ProctorU, it's not going to work either. You need to take your exam in the location for the section you're in, and I emailed you yesterday again to tell you where. And if you have any questions about that, you need to email me. Okay, how do you know what section you're in? Okay, so you know what section you're in you can look in Flashline if you want, but you can also see the email that I sent you yesterday, and I'm telling you where you're taking your exam. Will you be given, it's not a cheat sheet. I hate the word cheat sheet because I just hate the word cheat. You will have the exam equation sheet given to you either in the computer lab. They will have them and hand them to you. If you're taking it with ProctorU, they will give you a PDF of it. Okay, any questions from people in person? Anyone have any questions about any of them? Okay, something as we go forward here, just a couple things I want to emphasize. Will this week's recordings be uploaded to YouTube? The recording from Monday is already on YouTube. It takes anywhere from 4 to 48 hours to get the recordings on YouTube, but Mondays is already on YouTube. This one, today I'll put whenever it's available. The recordings are always available in Blackboard Collaborate immediately. Okay, another thing, don't rely on any time in My Accounting Lab. You have to start it before 4 p.m. Waiting until 3:45 p.m. to schedule your exam, or scheduling your exam for the last day, the very last hour, never a good idea. Okay, you need photo ID for your exam. Okay, let's see. Okay, I want to emphasize this. If there is any issue during your exam, you need to email me. Because I'm watching emails, not late at night, but the rest of the time I'm watching emails. Even if the proctor says, oh, I'll contact your instructor, no, it's your exam. It's more important to you than to the proctor because proctors can get distracted. This is high stakes for you. So if there's any issue at all, you email me after the exam. And I'm watching my emails, and if there's something that needs to be taken care of, I will deal with it. If there's any issue at all, I want to hear from you, and I will get back to you as fast as I can. Okay, for the online students taking the exam with ProctorU, when it is our scheduled time for exam when we sign on to ProctorU, will there be a link to our exam there, or how do they see us taking the exam? You will actually, when you're online with ProctorU, you get onto line with ProctorU, and you'll sign in to My Accounting Lab. You can either sign in to Blackboard or My Accounting Lab. You'll log in, and you'll actually take the exam with My Accounting Lab. Now, when you sign in, so ProctorU is right there with you. You're kind of doing like a screen share thing. And this is also in the lab. In the lab, you can sign into My Accounting Lab. You can go straight into My Accounting Lab, or you can go in through Blackboard. It doesn't matter. And then you'll go into Take a Quiz. So this is online and in person in the lab. You go into My Accounting Lab, click on Take a Quiz or Take a Test, and then you'll click on Exam 1. And then it'll pop up and ask for a password. And that's where ProctorU will put in the password for you. Or if you're in the computer lab, they'll put the password in for you. So it's going to be, and then you're going to be in the exam, and it's going to look just like what you've been seeing. It is identical. Do we have to schedule an appointment to take the exam in the computer lab? It's just walk in. It's just walk in, and just a heads up, there could be lines. Usually the danger of line is in the afternoon. I would say the line danger for our case is going to be Wednesday after about noon. Okay, if you take it early in the morning, you should be okay. Certainly Monday or Tuesday, I think you'll be fine. I hope there aren't lines, but you never can tell. Do not wait till last minute. Do we get our score immediately? Yes, absolutely. You will get your score, so take a big breath at the end when you hit submit. Your exam, by the way, here's something to know. Your exam does not finish until you hit submit. So let's say you're working along and your computer freezes. So it doesn't matter if it's ProctorU or in the computer lab, your computer freezes and you're like, this is the worst time in the world for this to happen. Well, don't worry, first of all, because you've got extra time. You've got the 2 hours, so your time's ticking away. What you need to do is restart your computer. If it freezes one time, it's probably going to continue. So restart your computer. Sometimes in the computer lab you can move to another computer, but tell the proctor what you're doing. But you can restart your computer, go back into My Accounting Lab, go to Take a Test. This applies to the quiz as well. If you lose your connection or freeze during the quiz or an exam, then just restart your computer, go back into My Accounting Lab. Now it'll say you've used one of your attempts. You really haven't. It just says that because it's incomplete. So then you go and take a quiz or take a test, and you will be back in your original practice quiz, or you will be back at the point where the proctor needs to enter the password. So don't worry. Until you actually hit submit, your exam is not submitted, or until time runs out. But so until you hit submit. Now, when you hit submit, it'll say, are you sure? Okay? That is the point of no return. Okay? Do not email me and say, oh, I accidentally submitted. Be very careful. Also, if you're online with ProctorU, make sure you do not close out ProctorU until you say to them, are we all set? Can I close the window? Because you do not want to close ProctorU before you've closed the exam. Okay. Oh, good question, Cody. Do we still have class Monday and Wednesday? No. Your job next week, and it's on the syllabus, your job next week is to take the exam. We do not have class next week, period. Okay? It is your job to take the exam. Do not wait till the night before to prepare for it. Absolutely. So we have no class next week. Okay? Are we going over anything on Monday? Or are we moving to Chapter 4? We are not. As I just said, we do not have class Monday or Wednesday next week, okay? And it's not in the syllabus. Okay, any questions from people in here again? I think exams are the worst. I wish we could, so to make certain, there will be no class. Yes, there is no class on the 15th or the 17th. We never have class the week of an exam. Yes. Mm-hmm. Okay, the question is, can we take the practice exam after we take the exam? Yes, you were right in your thought. So the practice exam, you have to take it at least once before the exam. If you're going to take it multiple times to improve your score, take it before the exam, because then that's going to improve your exam score. I don't actually shut it off until 4 o'clock Wednesday, but it would be a real waste to not practice it before the exam. But it doesn't actually physically shut down till 4 o'clock on Wednesday. Other questions? Yes. You can do the study plan anytime all semester, yes. Okay. I'm going to put up a question. Okay, so I have put up a question. So while you're answering this question, this is asking which of the following accounts will be closed at the end of the period. So to answer this question, you need to know two things. First of all, the accounts that are closed at the end of the period are revenues, expenses, and dividends. So you have to go through here and know which one of these is a revenue, an expense, or a dividend. There's only one account type here that is one of those. Okay, so let me just tell you what. So first of all, in your notes, you have revenue, expense, and dividend, right? So you know that those are the closing counts. So now you have that. So revenues, expense, and dividends. Those are the ones that are closed. Going through here, accounts receivable. What type of account is that? I heard an asset. Okay. Accounts payable. What kind of account? Liability. Yes. Common stock. What kind of account? Equity. So we're finally down to the last one, right? What kind of account? Is it wages, expense? Expense, right? So with closing, you close the red accounts, revenues, expenses, and dividends. Okay, so I don't see any other questions. Anyone have any other questions? I'll send an email out reiterating, know that I am always just an email away. I am going to a conference Friday through Sunday, but so I'll have some plane time that I won't be in contact, but other than that, I will respond to you as soon as I can. So good luck on the exam, and I'll see you in another week.